It's official. Trump just reset the Fed, and what happened in the last 72 hours is going to change everything about how money flows through the economy, where capital rotates next, and which sectors are about to benefit while others get crushed. Because while everyone's been focused on the Kevin Worsh appointment and what it means for interest rates, there's a massive rotation happening right under the surface that almost nobody is talking about. And by the end of this video, I'm going to show you exactly where that money is going, why home builders are suddenly the smart play, and what happens when everyone rushes to cash at the same time. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. And if you want access to my best trade of the day, based off a combination of market experience and algorithmic screeners that I use, plus daily recordings on market analysis that cover any questions you ask in the community, you can try my Discord, the Stocks Community, for just $25 for 7 days at stockscommunity.com. And if you're looking for a free resource, head over to free.stockscommunity.com, where you'll be able to sign up for my free newsletter and get market updates that I can't share here on YouTube due to the sensitive nature of the content, some of which involves government figures and their stock portfolios that YouTube can sometimes restrict on its platform. The link's in the description below. As always, if you're the one making the actual purchases and sells, you have to do your own diligence as well. This is not financial advice. I'm just sharing my research. Now, let's get into it. Here's what just happened and why it matters more than most people realize. President Trump officially announced his pick to replace Jerome Powell as the next chairman of the Federal Reserve, Kevin Worsh. And the market's reaction to that announcement tells you everything you need to know about what investors were actually expecting versus what they got, because this is way less bullish than most people thought Trump would choose, and the evidence is everywhere. The market sold off, gold collapsed, and suddenly all the trades that were built on the assumption of unlimited money printing had to reassess everything. But here's what's fascinating. While everyone's panicking about what this means for monetary policy, smart money is already rotating. It's moving out of the fear trades and into the growth trades, out of precious metals and into real assets. And one of the biggest beneficiaries of this rotation is a sector that's been dead for months: home builders. Companies like Lowe's, ticker LOW, Polk Group, PHM, and the home builder ETF, XHB. These names are starting to move, and I'm going to explain exactly why. But first, let me explain who Kevin Worsh is and why his appointment just reset the entire game. Worsh is a veteran of the Federal Reserve. He joined back in 2006 and left in 2011. Those were the years of the great financial crisis. He was instrumental in helping form the bailouts and the Troubled Asset Relief Program, TARP. This was when the Fed first started intervening directly in markets by buying assets onto their balance sheet. Treasuries, mortgage-backed securities, all of it. The Fed's balance sheet exploded from under $1 trillion to over $2 trillion in just months. But here's what's critical. After Worsh left the Fed, he became extremely critical of how policies continued, even though the emergency was over. He watched the Fed resume quantitative easing in 2011, then again in 2013, then the not QE of 2019, then the massive printing of 2020 and 2021, and the entire time, Worsh was calling it out. He's been on record saying that all of this monetary easing has directly contributed to the widening wealth gap in America. He pointed specifically to the drastic rise in asset prices. Stocks, real estate, gold, all of it. He said the Fed knew that QE and low rates would cause some asset appreciation, but the effect was much larger than they anticipated. And the opposite happened for the broader economy: wages, jobs, purchasing power, all much worse than the Fed expected. So not only did the rich get richer and the poor got poorer, but it also became harder to climb the ladder, because now it takes more dollars to buy stocks, more dollars to buy homes, more dollars to buy gold. Meanwhile, average workers haven't been getting paid enough to keep up. The wealth ladder got taller and the rungs got further apart. Worsh has been saying for years that the Fed is responsible for this. And here's the thing, he's right. Most people blame capitalism, they blame corporations, they blame the rich, but they have no idea how much the government and the Federal Reserve are to blame. The Fed enabled all of this, and Worsh knows it. which is why his appointment is so significant. Because Trump didn't just pick someone who will cut rates, he picked someone who is vocally critical of the policies that got us here. Someone who has explicitly called out QE and low rates as the cause of inequality. Someone who wants to shrink the Fed's balance sheet, not expand it. And that changes everything. Now, you might be thinking, wait, doesn't Trump want lower rates and more stimulus? Yes, absolutely. Trump has been begging for lower rates. He's been putting pressure on Powell. He even tried to charge Powell with fraud over a building renovation just to apply political pressure. Trump wants interest rates at 1% or lower. He said this publicly multiple times. He wants the US to have the lowest rates of any developed country in the world. But here's the problem. Even if Worsh cuts short-term rates, long-term rates are going higher. And that's what really matters for the economy. Because when short-term rates go down, the government can borrow more. They can spend more. And all that borrowing prints money into existence. That's how dollars work. Dollars are loaned into existence. So the more the government borrows, the more the money supply increases. And when the money supply goes up, prices go up. Rational investors see this. They see the government borrowing and spending. They see the money supply rising, and they say, I'm not going to lend the government money for 20 or 30 years at a low rate. I need to be compensated for the loss of purchasing power. So long-term rates go higher even as short-term rates go lower. The yield curve steepens, and that's exactly what's been happening. Now, here's where it gets really interesting. Because Worsh can give Trump what he wants and still maintain discipline, how? By shrinking the Fed's balance sheet while cutting short-term rates. Trump gets his lower rates, Worsh gets his smaller balance sheet, and the key to making this work is bank deregulation. Let me explain. There's something called the supplementary leverage ratio. This is a rule that restricts how many treasuries banks can buy. Right now, treasuries are considered risky for banks because they can go down in value. This is what led to the collapse of Silicon Valley Bank, but there's been a push at the Fed to remove this restriction to make permanent what temporarily happened in 2020 and 2021 when the rule was suspended. If that happens, banks can buy an unlimited number of US treasuries. And if treasuries go down in value, the Fed has a tool called the Bank Term Funding Program. Banks can sell treasuries back to the Fed for full price as long as they buy them back within a year, which means treasuries become risk-free for banks. The Fed's there to bail them out if needed. So here's how this all fits together. Trump gets lower short-term rates. Worsh shrinks the Fed's balance sheet. And banks do QE for the Fed by buying unlimited treasuries. Long-term rates stay lower than they otherwise would because banks have unlimited appetite. The government can borrow anywhere along the yield curve at rates lower than inflation. Banks are happy because they care about the spread between what they pay depositors and what they get from the government. And everybody wins except the little guy. Now, you might think someone like Worsh, who's been critical of these policies, wouldn't allow this, but history says otherwise. Alan Greenspan loved gold. He was critical of easy money, but when the dot-com bubble burst, he lowered rates and planted the seeds for the financial crisis. The Fed always does what the Fed has to do, because if they don't continue feeding the government's appetite for borrowing, the whole system enters a deflationary death spiral. So that's the macro picture. Worsh appointment, lower short-term rates, tighter balance sheet, bank deregulation to provide unlimited treasury buying. And this is where the rotation story begins, because the market is repricing. It's moving from fear to growth, from defensive assets to cyclical assets. And one of the biggest beneficiaries is homebuilders. Let me explain why. For months, investors were betting on worst case scenarios: dollar collapse, Fed capitulation, runaway inflation. That drove capital into safe havens, gold, silver, cash. But now the narrative is changing. Worsh suggests that maybe the Fed won't destroy the dollar. Maybe there will be some discipline. Maybe we're not heading into hyperinflation. And if that's true, then growth assets become more attractive than defensive assets. Lower short-term rates are bullish for homebuilders. Why? Because lower rates mean lower mortgage costs, and lower mortgage costs mean more people can afford to buy homes. The housing market has been frozen because mortgage rates went from 3% to 7%. Nobody wants to sell their house and give up their 3% mortgage to buy a new house with a 7% mortgage. So Inventory dried up, sales collapsed, and home builders got crushed. But if rates come down, that changes. If mortgage rates go from 6.5% to 5%, that's a massive difference in monthly payments. Suddenly, buying a home becomes affordable again. Demand picks up, and home builders benefit. Companies like Polk Group, ticker PHM, they build homes, they sell homes, and when demand increases, their revenues and profits increase. Lowe's, ticker LOW, also benefits because when people buy new homes, they need to furnish them. They need appliances, tools, materials for renovation. Lowe's is the home improvement play, and lower rates drive home sales, which drive home improvement spending. It's a direct correlation. And then there's the home builder ETF, ticker XHB. This gives you broad exposure to the entire sector, not just the builders, but also the suppliers, the retailers, the mortgage companies. It's a diversified way to play the housing recovery. Right now, XHB is starting to break out. It's been consolidating for months, building a base, and now it's showing relative strength while other sectors are rolling over. Now, let me address the question that everyone's asking. What happens when everyone rushes to cash at the same time? Because that's what we saw last week. Gold crashed, silver crashed, stocks sold off, and everyone said, I'm going to cash, I'm going to safety. But here's the thing, cash is not always safety, and understanding what happens when capital flows to cash is critical. When everyone sells stocks and buys cash, the first thing that happens is the dollar goes up because buying cash means buying dollars. And when demand for dollars increases, the value of the dollar increases. We saw this happen. The dollar turned up even as gold and silver collapsed. That seems counterintuitive, but it makes sense because people were selling everything and moving to dollars. But here's the problem. When the dollar goes up, that's deflationary. It makes debt more expensive to service. It makes exports more expensive. It hurts corporate earnings, and it creates pressure on the Fed to ease policy. So the dollar strength is temporary because the Fed can't allow the dollar to stay strong for too long without causing economic damage. So what's the trade when everyone goes to cash? You want to own the things that benefit from lower rates and a stabilizing dollar. And that's exactly what home builders are. They benefit from lower mortgage rates. They benefit from a stable dollar that doesn't crush demand. And they benefit from a rotation out of fear and into growth. But there's another layer to this because not all cash is created equal. When investors go to cash, they're not stuffing it under a mattress. They're putting it in money market funds. They're putting it in short-term treasuries. They're putting it in high-yield savings accounts. And all that cash is being deployed by the banks. The banks are buying treasuries. They're making loans. They're keeping the system liquid. So even though it feels like money is leaving the market, it's really just rotating. It's moving from equities to fixed income, from risk assets to safe assets, but it's still in the system. And when conditions improve, it flows back. That's why these rotations create opportunities, because the money doesn't disappear, it just moves. And if you can identify where it's moving before everyone else, that's where you make money. Now, let me tie this all together with the bigger macro picture, because what we're seeing is not just a Fed reset, it's a complete repricing of risk across the entire economy. For months, the market was pricing in chaos, dollar collapse, unlimited money printing, loss of Fed independence. That drove defensive assets higher, but now the market is pricing in something different: discipline, structure, maybe some tightening of the balance sheet, and that's bullish for growth assets. Home builders are the perfect example of this rotation. They've been dead for months. Nobody wanted to touch them. Mortgage rates were too high. The housing market was frozen. But now, with the prospect of lower rates, with the Worsh appointment signaling some discipline, with the market rotating from fear to growth, home builders are coming back to life. And this is where the opportunity is. Because most retail investors are still fighting the last war. They're still buying gold and silver because they think inflation is coming. They're still betting on the dollar collapsing. But smart money is already moving. It's rotating into the sectors that benefit from the new regime. Lower short-term rates, tighter balance sheet, bank deregulation, and a focus on growth instead of fear. Polk Group is one of the largest home builders in the country. They have a strong balance sheet. They're already producing. They're selling homes. And when mortgage rates come down, demand for their product goes up. It's that simple. They're not a speculative bet. They're an established business with real cash flow, and they're cheap relative to where they were before rates spiked. Lowe's is similar. Home improvement spending is directly tied to housing activity. When home sales increase, Lowe's revenues increase. They have the scale, the brand, the distribution network, and they benefit from multiple tailwinds. New home sales, existing home sales, renovation activity, all of it flows through Lowe's. And XHB gives you diversified exposure. You're not betting on one company, you're betting on the entire housing ecosystem. Builders, suppliers, mortgage companies, retailers. It's a basket approach. And in a sector rotation like this, baskets can outperform because you're not trying to pick the winner. You're just betting on the trend. Now, let me address some risks because there are plenty. Risk number one, what if rates don't actually come down? What if long-term rates keep rising despite lower short-term rates? That would hurt home builders because it's the long-term rates that determine mortgage rates. If the 10-year treasury keeps going higher, mortgage rates stay elevated and demand stays weak. Risk number two, what if the economy slows down more than expected? What if we go into recession? In that scenario, even with lower rates, people might not want to buy homes. Job security matters, income matters. And if people are worried about losing their jobs, they're not going to take on a 30-year mortgage. Risk number three, what if Worsh can't actually shrink the balance sheet without causing a crisis? What if the market can't handle tightening and the whole thing unwinds? We saw what happened in 2018 when the Fed tried to reduce the balance sheet. The market threw a tantrum and the Fed had to reverse course. The same thing could happen again, but here's why I think the setup is interesting despite the risks. The market's been so focused on worst case scenarios that anything less than disaster is bullish. Worsh is not the apocalypse, he's disciplined, but he's not going to crash the system. He'll cut rates where it makes sense. He'll tighten the balance sheet slowly, and he'll work with the banks to ensure there's enough liquidity. And home builders have been beaten down so much that the bar is low. They're not priced for perfection. They're priced for continued weakness. So if things even stabilize, these stocks can move higher. And if rates actually do come down and housing activity picks up, these stocks could run significantly. Now, let me talk about what to watch in the data because this is not a just buy and hope situation. You need to watch the signals. First, watch mortgage rates. If the average 30-year mortgage rate starts coming down from 6.5% towards 5.5% or 5%, that's bullish for home builders. That means demand will pick up. Second, watch pending home sales. This is a leading indicator of housing activity. If pending sales start to increase, that means buyers are coming back, and that flows through to home builder revenues in the following months. Third, watch home builder sentiment. The NAHB Housing Market Index measures how confident builders are. If that starts to rise, it means they're seeing demand. They're optimistic, and that usually precedes actual sales growth. Fourth, watch building permits. This tells you how many new homes are in the pipeline. If permits start to increase, that means builders are confident enough to start new projects. And that's a signal that the market is improving. And fifth, watch the Fed. If Worsh comes in and actually does cut rates while managing the balance sheet, that's the green light. That's confirmation that the thesis is playing out. Now, let me address the cash question one more time because it's important. When everyone goes to cash, the immediate effect is the dollar goes up. But the long-term effect depends on what happens next. If the Fed sees the dollar strengthening and the economy weakening, they'll ease, they'll cut rates, they'll add liquidity, and that reverses the dollar strength. So the trade is not to stay in cash. The trade is to use cash as a temporary parking spot while you wait for the next move. And the next move is into assets that'll benefit from easing. Home builders are one of those assets because lower rates make their product more affordable, and affordability drives demand. But there's another angle to this. When the dollar goes up, it makes US assets cheaper for foreign buyers. And we've already seen foreign capital flowing into US real estate. Chinese buyers, European buyers, Middle Eastern buyers, they see US real estate as a safe haven, as a store of value. And when the dollar is strong, they can buy more for less. So home builders benefit from both domestic demand and foreign demand. Lower rates help domestic buyers, a strong dollar helps foreign buyers, and both of those tailwinds are in play right now. Now let me wrap this all up because I want to make sure the main points are clear. Trump just reset the Fed by appointing Kevin Worsh. This is not the unlimited money printing pick that people feared. It's a disciplined pick, someone who wants to shrink the balance sheet while cutting short-term rates. Someone who will work with the banks to ensure liquidity without destroying the dollar. The market is repricing. It's moving from fear to growth, from defensive assets to cyclical assets, and homebuilders are one of the biggest beneficiaries. Companies like Polk Group and Lowe's, the homebuilder ETF XHB, these are the names that benefit from lower rates and a rotation into growth. When everyone rushes to cash, the dollar goes up. But that's temporary. The Fed will ease, rates will come down, and the sectors that benefit from easing will outperform. Homebuilders are at the top of that list. This is not a one-week trade. This is a position you build as the housing market recovers, as rates come down, as demand picks up. And the beautiful thing is, you're getting in before the crowd, before CNBC is talking about the housing recovery every day, before the stocks have already doubled. You're positioning now while the setup is fresh. The opportunity is real. The fundamentals are there. And the people who understand what's happening are going to make serious money as this rotation plays out. Don't wait until rates are already down and home builders have already run. Position now while the story is still developing. And if you want access to my best trade of the day, based off a combination of market experience and algorithmic screeners that I use, plus daily recordings on market analysis that cover any questions you ask in the community, head over to stockscommunity.com. Try my Discord, the Stocks Community, for just $25 for 7 days. We break down rotations like this in real time every single day. Plus, if you want market updates I can't share on YouTube, sign up at free.stockscommunity.com. The link is in the description below. So what do you think about this Fed reset? Do you think home builders are the right play? Do you think Worsh can actually pull this off? Let me know in the comments. I love hearing from you, but that caps off the video. If you found this valuable, smash that like button, subscribe to the channel, share this with somebody who needs to hear it, because the rotations are happening right now. And the people who position correctly are going to make a lot of money in 2026.